Hello and welcome to our learning platform. Today's topic is one that affects us all, but many of us do not understand what it means fully. We are going to talk about what is bank run. A bank run can be a terrifying experience for both the bank and its customer. It is a situation that can lead to severe financial losses and even the collapse of a bank. So let's start by defining what bank run is. A bank run is a situation where a large number of customers withdraw their deposit from a bank simultaneously, out of fear that the bank may not have enough funds to meet its financial obligation. The fear of losing their money makes people to act in haste, and this creates a vicious cycle that can cause the bank to fail. In the world of finance, bank runs have long been regarded as an economic disaster. They are the result of sudden and simultaneous withdrawal of funds from bank by its customer, which can lead to a domino effect on other customers following suit, ultimately causing the bank to fail. Bank runs have been the subject of many discussions and the debate, especially since the Great Depression, which perhaps the most famous case of bank runs in modern history. The Great Depression and bank runs of 1929. In the wake of 1929, the stock market crashed. American depositors began to panic and sought refuge in holding physical cash. This led to succession of bank runs on thousands of banks in the early 1930s, causing a domino effect that worsened the already dire economic condition. In response to the bank runs of 1930, the US government established several regulatory mechanisms to prevent future bank runs. One of the mechanisms is the Federal Deposit Insurance Corporation, which insures depositors up to $250,000 per banking institution. This insurance coverage is meant to protect depositors in the event of bank failures. Let's now look at the modern example of bank runs. Despite the existence of regulatory mechanisms like FDIC, bank runs still occurs in modern time. In March 2023, the collapse of Silicon Valley Bank was as a result of a bank run caused by venture capitalists. The bank reported that it needed $2.25 billion to shore up its balance sheet. And by the end of the following business day, customers had withdrawn about $42 billion. This led to regulators to close the bank and take control of its assets. Silicon Valley Bank has last reported $12 billion in assets as of fourth quarter of 2022. Making it the second largest bank failure of all time. Washington Mutual Bank, WAMO, was the largest bank failure in the US at the time of its collapse in 2008. The bank had about $310 billion in assets, and the failure was caused by a number of factors, including a poor housing market's rapid expansion. Customers withdrew $16.7 billion within 2 weeks, leading to the bank failure. WAMO was eventually bought by JP Morgan for $1.9 billion. Imagine their initial asset was $309 billion. Another example is the Northern Rock crisis in the UK in 2007. It was the first British bank in 150 years to suffer bank run. The bank customers were concerned about the security of their deposits, and they queued outside branches to withdraw their money. Now let's talk about how a bank run works and how it can be avoided. A bank run starts when one of few customers withdraw their deposit from the bank. This creates a ripple effect as other customers begin to worry about the safety of their money, and they too start to withdraw their deposits. As more and more customers withdraw their deposits, the bank reserve begins to dwindle, and it becomes increasingly difficult for the bank to meet the demand of its customer. The consequences of a bank run can be severe. If a bank fails to meet its obligation to its customer, it may be forced to close its door permanently. This can lead to significant financial losses for customers as they may lose their deposits. Additionally, a bank run can have a significant impact on the wider economy, leading to recession or even depression. Now, the question is, how can we prevent a bank run? There are several ways to do this, including increasing public confidence in the banking system, improving regulation, and providing deposit insurance. A bank run is a terrifying experience for both the bank and its customer. It is a situation that can lead to severe financial losses and even collapse of a bank. It is therefore essential to understand the cause and consequences and prevention of the bank runs. We hope you found this video informative and valuable. Thank you for watching.